I was thinking we had 3 more classes, we only have 2 more. So we're gonna have to just cut some stuff out. You can read the class notes, the ones we don't get to. I gave you that problem last week, so if you worked it, I'll just have to work it on a YouTube video or something. Forget which one I gave you. Let's see if I can find it here. Did any of y'all try working it? No, that's not it. So I'll work it once I can find. I can't find what I gave y'all. I can't remember which one I gave you. I'll have to look on the video, but so you have that one. I'll work it for y'all on a YouTube or something. I'll get the exam guide out by Friday, which has links to some YouTubes, and then maybe I'll just add another YouTube for that last problem that we did, because we do need it. We do have to kind of jump ahead here. The papers were better than prior classes, so I think I'm really working hard to make sure everybody's with me, taking the notes, cutting and pasting helped quite a bit. You'll notice that your coverage score is the same as the clarity and critical thinking, because I was grading it all at the same time going through. So I just gave you that score kind of tied down. Some of y'all have the title. You're going to say, well, you didn't give me points there, but you had the title, but then they didn't talk about what was in the title in the paragraph. There's a few times where I had a title, malpractice insurance, and then the paragraph had nothing to do with it. So I didn't give credit if it was just in the title. You had to kind of talk about it. So some kind of got confused on what that title was about. So just because it was in a title and you had a section for it, doesn't mean that you get credit. Any questions on the paper? Is that the longest rubric you've ever had in your entire college career? So it's the longest one I use in any of my classes. Most of y'all followed it exactly in that order. I would probably change it up. For example, it doesn't make sense that technology is the first problem. I would probably move that down much lower. It does make sense to start with the employers and the taxes, because I think that's a pretty critical starting point. So some of y'all did actually move it around in different sections. The extra research was interesting. A few of y'all hit Bernie Sanders pretty hard. Some of y'all looked at Mark Cuban or looked at some of these websites that do things. Some of y'all gave personal stories, which I thought were interesting. Family events. I've yet to have anyone say you're way too hard on this industry. It's far better than what you're saying. Most people are like, yeah, I saw exactly what you're talking about. It was this, it was frustration, wrong incentives. And not only that, but you're even hearing it from people in the industry, doctors and nurses. Someone was talking about, I forget, they probably want to be identified with them anyway, but having a family member or a friend who was a nurse, and sure enough, yeah, nurses talk to each other and they know what's going on. They're probably the best source if you can get an operation of where you should go. So any comments, questions? Any y'all get in debates over Thanksgiving? All right. So we're going to shift gears here. Well, we've got to do the joint life too. I haven't done that one yet either. So, okay, well, let's do the joint life policy problem. So yeah, we're going to have to move quickly here. So we're not going to do the second problem. So what we need to finish up for the exam is the joint life and the asset liability management problem. So those are the 2 big ones. We should get those done tonight and Thursday night. The joint life, I do have a YouTube that you can watch on that one, and on the ALM there's a YouTube. So you have additional into what we're doing here. So let's look at joint life. It's a little bit different, mainly because of the extra analysis we want to do. I'm going to put this at the very, very, very bottom here. Right. So joint life is the life insurance is on two people's lives. It can be first to die. It could be second to die. First to die is usually somewhat what my parents did is say, hey, I've got a pension. And this is an important analysis. I really wish I had time to work through this analysis, give you an actual case, because it's really interesting stuff. So when someone gets a pension, they've got a choice. They can make it joint or individual. If to make it an individual life, the pension's much, much larger. If they do joint, it's smaller. So they might say, hey, if you make this just on your life, you'll get $4,000 a month. If you make it on your life or your spouse's life, whoever dies second, then it's only $3,000 a month. So you're giving up $1,000, $500. So you got to decide, hey, do I take the joint life and only get $3,000 a month? Or do I do just on my life and get the $4,000 a month? Well, joint life addresses that, the first to die, because what it says is, okay, I'm going to do that just on my life. I'll get the $4,000. I'm going to take some of that. I'm going to buy a joint life policy. So if I die first, this policy pays. And so my pension goes away, but then they can use this life insurance to create their own pension. And what you're doing is you're trying to decide between the two of those. So that's exactly what you're going to do. Your parents are going to face this. So your mom or dad that has a job that has a really nice pension, and they've got to decide, do I make this joint or individual? And a lot of people make that decision without much analysis. You actually want to sit down and look at the difference in those two. So if it's individual, let's say it's $4,000 a month. If it's joint, so maybe it's $3,500 a month. So the difference is $500. So you have $500 a month. What would you do with that number? Well, the first thing I would do is how much whole life can I buy? So let's say you could buy $250,000 of whole life insurance. So now you got a question. Do I want $4,000 a month with no whole life insurance? So when I die, my spouse keeps getting $4,000. Or do I want $3,500 a month with $250,000 in insurance? Well, if you think you can make 4% on that, then your spouse is going to get an extra $800 a month. Y'all see how I did that? 4% times 250 is $10,000. So if you die, let's say the husband dies, the spouse is going to lose all of that $4,000. It goes away. But what's she going to get instead? She's going to get $250,000. If they do this, she gets 30. When her husband dies, she still gets $3,500, but she doesn't have the $250,000 in insurance. So which would you recommend? Well, if they put the entire $500 into that, they're no better off. Or well, I guess they're a little bit better off. But you might ask, how much do I need to make up for that $500? So if you think you can make 4%, let's take $500 divided by 4%, multiply that by 12. So if I can get $150,000 of insurance, that's going to give me that $500. So how much insurance do I need? I only need to spend $300 a month on insurance. That gives me an extra $200, right? Y'all see where I'm going here? Am I confusing y'all? Individual pension. So with that, what do you get? Your monthly is $4,000. You buy whole life at $300. And so you're going to end up with $3,700 a month until he dies. When he dies, what happens? She's going to get $150,000. She's going to invest 4%, which is not that hard to do today, is it? You got high quality bond funds that are paying 4% today. So it's not that outlandish. We have to think about taxes, but all of this is taxable anyway. So I'm ignoring taxes. So that times 4% divided by 12, that's wow, I did something wrong. That should be, oh, that's $500. So, what's she gonna get? Boy, did I do the math wrong? I might have done the math wrong. So yeah, I think I did the math. But anyway, you see, so I'm trying to go too fast. But this is the type of math you got to do. So I guess I needed to replace the entire $3,500 if I did that. But anyway, that's the kind of math you got to do. You got to figure out which is the better approach. So how much whole life can you get? How much income could you get off of that? Could that replace this? So essentially I didn't replace it. I only replaced 500. So I wasn't thinking correct. But that's what they need to do. They need to figure out what they have. Now, what my parents did is they just took the individual life and bought the insurance. They bought universal life, unfortunately, which is a much worse policy. They didn't sit down and do all the math to try to figure out which would be better. I wish they had bought it on the joint life, because that would have made more sense, because my mom was much more likely to live many more years than my dad anyway. So that was going to be probably the better decision. There's not a perfect way to figure this out, because you do have to figure out, I guess with the 250, you'd have to figure out how many years you need that. So, if you're going to take $3,500 from that every year, you're going to have to see how long that would last. You're essentially taking 17% away from every year. How long would that last, and what's that person's life expectancy? So there's quite a bit to set up here. You got to figure out when the first person is going to die, when the second person might die, how much longer would they live. So that's what you're looking at. So, but joint life is a really good solution for that, and we'll see why that's the case. So we got the husband is 70, the wife is 90. It's a $10,000 policy. And it pays first to die. All right. So once someone dies, they get 10,000, the policy stops. So how much should the premium be? Well, we got to ask about the probability it pays. What's the probability that it pays? So this is a 1-year life policy. What's the only reason this policy will not pay anything? What if the husband dies? What happens? It pays. What if the wife dies? It pays. What if they both die? It pays. When's the only time it doesn't pay? They both live. So what are we looking for here? 1 minus probability both live. What's the probability they both live? L71 divided by L70. What is that? You know what L71 divided by L70 is? Probability of what? Someone found the note. I'm just not saying. Someone's yelled out. L71 over L70. The probability that the husband lives, right? Probably let the husband live. What am I going to do with that? Times, what do you think would come next? Over L90. Okay. So that's the probability both live. So if we take 1 minus all of that, we're going to get the probability of 1 or both dies. So we need L70, we need L71, we need L90, we need L91. L70, 64,000. L71, 62,000. L90. Man, a lot of people have died, haven't they? All right, so probability both live is that divided by that. So his chance of living is 96%. Her chance of living, well, I can't tell you, but the chance that they both live is about 75% chance that they both live. Why is it such a low probability? Because she's 90 years old. So the probability of her living is pretty low. It's only 78%. So the probability of his living, I forgot what we said before, but it's much higher. 96%. So 96% times 78% is 75. So most of it's her because she's 90 years old. So she's going to be the bulk of this premium. And we know we can't do that because it's a male table. So, you know, we have to kind of ignore that. This table works with men and women. I don't know if the mortality is always better for women all the way to the bitter end, or if it's like in the 60s and 70s, women do better. But once you make it to the 90s, I don't know. I haven't looked at a mortality table in a while to see. So the probability one or both die is going to be about 25%. So there's a 25% chance. Okay. So what's the premium going to be here? So the premium is going to be probability one or both die times the face divided by 1 plus I. Does that formula make sense? So probably they both live, or maybe one or both dies times the face, but then we have to take the discounted value of that. So we take 25% times 10,000 divided by 1 plus, what was the interest rate? 5%. So there's your premium. Very expensive premium. Why? Because she's got a very high probability of dying. She's got a 25% chance of dying, and both dying, or well, or I guess it was 22%, but both dying. There's one chance in 4 there, 1 or 2 of them, or both of them are going to die. All right. Why would you buy this policy? And this is what you got to do on the exam. Why not just buy 2 term policies? Why don't we just buy a policy for the husband and a policy for the wife? Why do this joint life? Well, what will that cost? Well, that we already know. The husband, that's going to cost D70 times the face divided by 1.05 divided by L70. Does that formula look familiar? We did that over and over and over again. We're only doing 1-year term here, so that's pretty simple. So D70, let's go get D70 in there. D70 is going to be 2566, which is nothing more than L70 minus L71. And so the 90 is 1400. So we'll take plus D70 times $10,000 divided by 1.05 divided by L70. That's pretty cheap. Say, why pay $2,400? We can just pay that for him. What about the wife? Anybody know on the wife what that's going to be? Maybe D90 times 10,000 divided by 105 divided by what? L90 plus D90 times $10,000 by 1.5 divided by L90. Together, it costs $24.88. So the joint life saves them what? About $84 or $83. So which would you recommend that they do? So what's the only difference other than the premiums? If the husband dies, what do they get? get $10,000. If the wife dies, what do they get? $10,000. Doesn't matter. So when does it matter? If they both die. If they both die, the joint life gives you what? $10,000. The two terms give you what? $20,000. All right. So I want you to actually do this on exam because it's a really good exercise. The difference is the probability both die times $10,000 divided by 1.05 should equal what, do you think? 8346. Y'all think that'll work? What's the probability they both die? D70 divided by D71. D70 divided by L70 times what? D90 divided by L90. Accidentally hit the Bill Gates should like have an alarm go off anytime you hit the like key. L90. Let's see what that probability is. It's probably really, really small, isn't it? So D70 divided by L70, that's 4%. D90 divided by L90. The probability of both of those is there's only a less than 1% chance they both die. So let's take 0.88 times 10 divided by 1.05. I hope it's right. Does that look right? 8346. So what would you recommend that they do? Well, $83 is $83. That's a dinner out, maybe. Well, McDonald's maybe, but it's, it's a dinner out for one of them. Well, it depends. If all they care about is providing some money if one of them dies, then they should probably save the $83. Why spend an extra $83? If you're both dead, you say, we don't care. We don't have any kids. We don't have any dependents. We're not worried about estate taxes. Might as well save the $83. So it kind of depends on how important that extra $10,000 if they both die. Now, there's one serious problem with this analysis. What did I just, when I multiplied this, what did I assume? About the chances of them both dying. Anybody remember that from your stats class? That it's what? It's uncorrelated. Does that make sense? Husband and wife, they're in the same car, they're on the same planes, eating the same possibly poisonous food. Is the chance of them both dying at the same time, is that uncorrelated? It's not uncorrelated. So I'm somewhat ignoring that. I've asked actuaries about that. How do they take that in consideration? That's the problem even with the joint life. How do you take that in consideration? But it's a bigger issue here. So if they buy two term policies, yeah, I mean, there's a small chance they could both die, but it's probably higher than 0.88%. They both die in the same auto accident. The other problem you have on the joint life is you might think this has never come up, but I'm sure there's been many court cases on this. What if they die together? What if they do die in a car accident? The joint life says what? 10,000 to the first to die. So if the husband dies first, the 10,000 belongs to the wife. If the wife died first, the 10,000 belongs to the husband. You think that ever creates a debate? What about the wife's stepchildren? Do you think they care who gets the money, the husband or the wife? What about the husband's natural born children and the wife's, this is his second wife? Yeah. They have to actually go and figure out which of the two died first. Because it matters on estate, something like that. They both died. Where does this go? Because the wife as a beneficiary, she may be having all of her money going to her kids. The husband as the beneficiary, he may be having all of his money going to his kids. So these are court cases they have to figure out, and it seems pretty morbid. But can you try to figure out which of the two of them died first? That may be impossible. What if they died at the exact same time? I don't know what insurance companies do in that case, but it's a legal issue that they got to figure out. So joint life can be pretty confusing. On this one, you don't really care. If they have two policies, they both can get 10,000, and so it's just they're both gonna be in the same position, right? So what I want to do on the exam, and there is a YouTube that walks you through this. First thing you have to do is come up with this premium, and then you need to compare it to this, and then I would recommend that you actually calculate and make sure you got the difference correctly calculated. All right, so you go through that. I love this problem because it really makes you manipulate that mortality table, which is really what I'm after, especially for actuary majors. Get used to manipulating that mortality table because it's not as complicated as it seems. If you have friends watching you do this problem, and you should try it, your friends that haven't taken this class, and just say, hey, this problem is real simple, and you walk through it, they're probably going to think, man, that's the most complicated thing I've ever seen. But to you, you're saying, no, it's just statistics, it's just probabilities. So let's do it again. But what I want to do this time is to show you that it makes a big difference when we change the ages. So what difference is this going to make? What would you think you'd recommend in this case? Husband's 25, the wife is 27. Would you recommend the joint life in this case? I would argue absolutely not. Why would you think I would say that? What's the probability that they both die in the same year? Practically zero, which means the difference in the two premiums will be what? A penny or something, almost nothing. So there's no reason for a 20-year-old to buy joint life. They should just buy two-term policies. So, but let's do the math real quick. So we need L25, we need L26, we need L27, and L28. And so that makes it really convenient. And then we have our D25. Right, so we do probability both live. So I'm going to take L26 divided by L25 times L28 divided by L. You think it's going to be both live? Probably going to be in the 90s, isn't it? You hope so. Probably really high 90s. Almost 100%. Right, so plus 1 minus that, we take $10,000 times that divided by 1.05. Here's your premium, pretty low premium. Probability. I've been typing really badly all. Die. So the D25 over L25 times D28 over L27. I mean D27 over L27. So this is D25 over L25, D27 over L27. Oops, what did I do wrong? Oh, times, that should have been divided. I can say, wow, that was a really high probability. Right, so there it is. So how much is his policy going to be? Oh, 177 divided by 100,000 times 10,000. Are y'all getting used to what I'm doing now? You're not just like, wow, what is he doing? Y'all got the formulas down, don't you? It's getting pretty straightforward. That's $16 per policy. L27, I mean D27 divided by L27 times 10,000 divided by 1.05. I don't know what oh, that's a Bill Gates thing. I've seen that before. Add those two together, you get 33.10, 2 cents. What financial planner is going to say? I mean, we can make it a $100,000 policy, so it's 20 cents. Or $1 million policy and it's $2. What planner is going to say, hey, you really should buy the joint life because it'll save you $2 a year? That's probably not going to be in the conversation. It doesn't make any sense. All right, so let's figure it out. The probability of both die is that times 100,000, I mean, times 10,000 divided by 1.5, and there's your 2 cents. I guess it's actually some rounding issues here, so it's actually 3 cents. So that must be 04, 07. So yeah, it's a 3 cent difference, 2.9 cent difference. It's just not worth it. So the only time joint life really makes sense is for people really up in their 70s and 80s, and there is going to save them. You know, you can think in terms of percentage savings if you want to. So it's going to save you 3%. That way, if you're talking about $1 million policy or 500,000 policy, you can just take 3% of the premium and figure out what that is. So that's the joint life. I'm only doing 1 year term because it gets really complicated if we do 2, 3, 4, and 5 years. So I'm saving you that. So I just want to do 1 year, but you could probably figure it out if I gave you a 3-year. I'm not going to do that, but if I gave you a 3-year joint life, you could probably figure out the math there. It gets a little tricky, but you essentially want to know the probability they both live the 1 minus probability they both live the first year, and then you do that for the second year. Then for the third year, you know, you could probably figure it out. Questions on that one? So none of y'all should buy joint life insurance. All right, so joint life does have some legal issues. They die in the same automobile accident. It can create quite a bit of confusion. How often that's happened? Probably enough times in a country of 350 million. It's probably happened enough time that there's been some interesting court cases out there. Younger people should not buy joint life. Older people, it really depends. How much are you saving? You can see if I've done that with 2 70-year-olds, the savings would not have been all that great. Most of the savings is coming because she's just so old, so much older. So it just reflects the higher probability. So, you know, yeah, if you buy the 2 terms, you're paying more, but there's a good chance you're going to get that 20,000. But if you're both dead and you say, we don't care about the 20,000, then you might as well save it. So why are you buying the insurance? And if you don't care, you don't have dependents, you don't care if you have the extra 20,000, then save the $80, go out to dinner one night, and you're good. All right. This is an old article, and I think it's probably changed. So I think COVID, drugs, and unfortunately suicide rates. There's some things that have happened the last few years that have really changed statistics. So this is an old article, but men were closing the gap on women. I bet it's reversed since then, but they were closing the gap. The difference between the life expectancy of men and women, you can see, had improved significantly here. I don't know on the drug side. And my guess is it's probably a bigger issue for men than women. Now the question of why is this? Some people think it could be the jobs men and women are taking are not as different they used to be in the past, so that difference is not as much. Who knows? You know, there's stress related things. So the article talks some about this. So I guess it's good news for men. It's not that women are living shorter, it's that men are living longer, but we definitely have seen that reverse here. Cool thing is there's actually a website on this. I don't know how active it is. I haven't checked it yet this semester. So there's a longevity science panel. What all they do, I don't know. Here's some members. Wow, that's a cool name. Does that mean she's like a knight or something? What is? I mean, professor. That's professors. A sir is a dame the opposite of a sir? I don't know anything about the UK. I don't know. But it's in the UK. I don't know if there's a longevity science panel in the United States. There's a lot of latest reports. Effect of climate change on health in UK. Mental health, age, gender. Women are likely to be impacted more by climate change than men. They are more often the primary caregivers, and responsibility can be considered an additional source of stress. Age, the young and the old are disproportionately impacted. Now, there's some debate on climate change because the number one climate killer of old people is not hot weather, it's cold weather. So there's some people who think climate warming may actually save lives because we'll have warmer temperatures because more people, but you know, there's some debate on that. I've heard that. But anyway, interesting website. Here's their whole PDF if you want to read it. So. All right. How long will you live? This article is kind of interesting. A guy did a study. How likely someone is to die in the next few years by testing how strong their grip is. The average grip strength the team recorded was 300 newtons. I don't know how much that is. Every 50 newton drop associated with a 16% rise in the risk of death and a 17% increase in the risk of dying from heart disease. Also associated with a 7% greater risk of a heart attack, 9% risk of a stroke. Those with cancer and chronic heart, a strong grip were more likely to survive the follow-up period than a limp. Correlation held when research is correct for others factors. Does that make sense to you? So this is one of those correlation questions. Can someone with a limp grip improve their chances of living longer by strengthening their grip? Or is the weak grip telling you something else about them that's going on? That people with certain heart ailments and something tend to have a weak grip. And so strengthening your grip doesn't do anything. The grip is just telling you what's going on. So who knows? I seriously doubt if you strengthen your grip, you're going to necessarily increase your mortality. Y'all have heard this with flossing too, haven't you? People that floss their teeth every day live longer. Does that mean if someone suddenly starts flossing their teeth, they're going to increase their life expectancy? Or is it that people that floss their teeth are just more careful people? You know, so it's hard to say. So it's impossible to know whether muscular weakness is causing illness or is a symptom. If the former is true, then building up your strength, building up your grip could actually make you live longer. If it's the latter, then it probably doesn't matter. So how strong, do you know how strong your grip is? I met a guy once from, he worked for Morgan Stanley, no, he worked for Merrill Lynch. That guy would crush your hand when he shook it. And the guy I worked with that had a hand operation, he was like, I'm never shaking that guy's hand. So that guy's going to live to like 130 or something. It was just crazy, but you should do this. I should have told you this before Thanksgiving, and you could say, hey, let me shake your hand. Oh, no, you know, that kind of thing. It could have been interesting. All right, we're going to have to skip benefit of survivors. If we have time, I'll do it Thursday night because I really love it. I think it's really, really cool stuff. But we got to flip over to asset liability management. One of my favorite topics. So if you're an actuary, you're more likely to be a P&C actuary than a life because there are more jobs on the P&C side. But the advantage of the life insurance side is there's a lot more investing on that side. P&C actuaries don't think much about the investment side. And so on the P&C side, you think about it, you have pricing actuaries, you have reserving actuaries, you have CAT and reinsurance and product development. On the life side, you have pricing, you have reserving. You don't have CAT and reinsurance. You do have product development. And you have ALM. So on the P&C side, you get to deal with catastrophes and reinsurance. On the life side, you get to do ALM. So ALM has an A in it. That's the asset side. So life actuaries study investments. They study interest rate theory. The property casualty side does not get involved on the investments at all. So it might be a decision to make. Usually these departments are two really, really nerdy actuaries that no one ever talks to because their job is just so computer modeling, quantitative. They're kind of the weirdest people in the company. They were my best friends at UTSA. I learned so much from these people who are in that department. I didn't get to talk to the pricing side very much at all because they had no need for me. I talked to the CAT people a lot on the P&C side. I talked to ALM people a lot on the life insurance side. It's a really cool job because the investment people, there's no way they're going to understand the liabilities for life insurance. It's far too complex. So you have to have the actuaries do that. But the actuaries have to tell the investment people what to buy. So the life insurance actuaries have to understand their liabilities and they have to understand the assets that are going to go into those liabilities. The property casualty side doesn't have to do that so much. Property casualty side, they just manage the business and the investment people just make sure they're investing in intelligent things. So it's a much more hand in glove between life. I know the ALM guy at UTSA, very, very impressive guy. One of my favorite people there. I was at his desk all the time. He had a very close working relationship with the portfolio manager over in the investment company. He actually told him exactly what he should buy. He told him the duration, the convexity, the credit quality. He said, this is exactly what we need. It was incredible how precise he was. I think it's probably one of the best departments in the country in that particular area. But it's one guy, really, literally one guy. Sometimes it was two, but the second guy kept quitting and they kept hiring another guy. So I don't know what's going on over there. But it was one guy who did everything. If that guy if he had dropped dead, they would have been in a lot of trouble because he had it all down to a science. It was really amazing. Very smart guy. He thought I was pretty stupid, and I was compared to him, but I didn't mind that. I just sat and learned as much as I could from him. So assets minus liabilities is your net worth, but for insurance companies, they don't call it net worth, they call it capital. So insurance companies and banks, when they say capital, they only look at the equity of the firm. For most firms, when they say capital, like Walmart or Amazon or whoever, when they say capital, I mean debt and equity. Banks and insurance companies, capital is just the net worth. Why? Because they don't generally borrow money. Generally, their liabilities are customers, their reserves, their CDs, their whatever, their bank deposits. So they don't think of their customers as capital providers. They think of their capital as the net worth of the firm. So when they say capital management, they really mean management of the equity of the firm. So what are they saying by capital management? They're saying, let's look at all these scenarios in the future and let's see if there's a scenario out there where we lose all our equity and go bankrupt. So essentially, they're managing the firm's risk to keep the firm from going bankrupt. It's an extremely important function. And that's what the ALM people do. They say, hey, what if interest rates shot up really fast? Would that cause us to go bankrupt? Right. So assets and liabilities, it's mainly driven by mortality. The assets don't care about mortality. Inflation is not an issue for life insurers because if you die, you get the face of the policy. You don't get the face of the policy plus inflation. So inflation is not an issue. So what's the key link between assets and liabilities for insurance companies, especially life insurance? It's interest rates. P&C companies, there may be some inflation link between the two of those because they're paying for cars or rebuilding buildings. But for life insurance, the key link between assets and liabilities is interest rates. Now, actuaries, you're going to have to study this in one of your exams, I believe. Boy, it can get really complicated. No, it's not the simple one. It's not these. It's not the simple ones you learn in 3013. In fact, we skipped it, at least in our class, because we ran out of time. So, see if I can. Yeah, so see if I can make it more interesting. So they have some words you've never heard before. So I can't find a good one. Maybe I'll look for one before Thursday's class. But it may be actuarial exam 9 or 10 or whatever you go up to. It gets pretty complex on the life insurance side. It may not be on the P&C side. But there's theories about interest rates, how interest rates move, how the long end moves versus the short end. There's these arbitrage-free theories. I could probably even put that in there. Arbitrage-free I can spell it. Arbitrage pricing theory, that's not it, but there's one. You're going to find very quickly it gets way over the heads of finance. This is very, very advanced mathematics. So that's why actuaries have to be involved in this. Here's some of the theories you'll see. I mean, how far do you have to go in this before you see words you don't know? A unit length of unique length types. Do y'all know what that is? Considering all of the insured species, expected unit length type. When's the last time you used those words in a sentence? All together. Y'all know what that word means? So it gets quite advanced really quick. So that's the advantage of being a life actuary is you're in an expertise that is really unique. And talking about interest rates, where you're going to understand interest rates better than people in finance do. It's pretty amazing. You would think finance people know interest rates, but actuaries is a very specialized case. So it's an interesting job, pretty incredible. All right. So what are the scenarios we have? So you could have a scenario where your liabilities go up. That sounds bad, but it's not so bad as long as your assets go up at the same time. You could have a scenario where liabilities fall. Well, that's good. And in that case, it's okay if your assets fall. So it's okay if your assets fall if your liabilities also fall. It'd be wonderful if your liabilities fell and your assets went up. That would be wonderful. But the only way to do that is to create this, where your assets fall when your liabilities rise. We don't know any way to create something where you get this, your liabilities go down, your assets rise without creating this risk. So where does the insurance industry want to be? They want to be in these green buckets. They want to make sure that when their assets fall, that their liabilities are also falling. And when their liabilities rise, their assets are also rising. That's what they got to do. They got to match these two. So the word ALM can mean asset liability management. It could be asset liability matching, and it can be asset liability modeling. They all mean, you see a department, you'll walk into a life insurance company and there'll be a sign that says ALM. Go ask them, what does the M stand for? And they'll say management, matching, and modeling. I may tell you all three. It could be ALMMM. So why management? Because you're trying to manage the net worth of the firm so the firm doesn't go insolvent. How do you do that? You do it by making sure you match your asset liabilities so they move together. And how do you figure that out? You do it by modeling the business. Okay, so all three of those M's fit perfectly with this. Okay, what if interest rates rise? That's where you have that disintermediation risk. Insurance interest rates rise, bank CD rates are now really competitive. So people take their money out of the life insurance company and they move it to the banks. That's a risk. What about when interest rates fall? That's when you have these guaranteed minimums that you have to pay at least 3% on the policy. Interest rates are falling, now you're losing money. So insurance companies lose. I'll show you on Thursday a graph of that because I want to show you what I mean by a short straddle. Right. So life insurance companies love it when interest rates never change because they make this nice spread and make a lot of money. They hate it when rates rise a bunch because their business goes somewhere else. They don't mind rates falling unless they fall a bunch because then they have these guaranteed minimums they got to pay. So insurance companies love stability. They hate volatility. That's why I think this year is going to be pretty interesting. There's some life insurance companies. They sold a lot of annuities in 2008. It was pretty amazing what a great year they had in 2008. And they sold it when interest rates are much higher. And then interest rates fell a bunch. So they're paying these guaranteed rates. And now interest rates have shot up. The advantage they have right now, if you look at banks, bank CD rates have not risen that much yet. But if bank CD rates start to rise to 5-6%, you're going to see a lot of money leaving life insurance companies and going to banks. And so huge risk for them. All right, so we'll talk more of that, but I want to give you an example of how to really understand this business. And I love this example. I had to think a lot about it, how to actually show you this mathematically. So I want to prove to you why life insurance companies do not buy treasuries or AAA bonds. They only buy BBB and high yield. I want to show it to you in the numbers. These numbers used to be really out of whack, but now they're not actually all that far off anymore. Last year when this exam was like, wow, my treasury rates were 5%, but now they're getting close to 4 again. So let's say this insurance company is selling an annuity for $100,000. Someone walks in and says, hey, I want to invest $100,000 in a deferred annuity. So you now have $100,000 of their money. You're going to pay them an interest rate, but you're going to pay them an interest rate by investing. And here's your 4 choices. You can buy in a treasury that's going to pay 5%. You can buy AAA, it's going to pay 6.25%, BBB 6.25%, or a high yield bond. Y'all know what high yield is? The below investment grade, a risky bond. That's a pretty good spread for AAA. So my numbers are not too good here, but high yield 13%. High yield's not quite back up to 13%, but we're definitely getting close to 10 again on high yield. BBB is not anywhere close to 7.25 yet. But all right, so if you buy this bond, you have to set aside some capital. And here's your capital charge. If you buy treasuries, you don't have to set aside any net worth for the treasury because it's so high quality, you don't have to worry about it. You buy the AAA bond, you have to set aside 0.3% of that 100,000, but your risk-based capital target is 150%. So this 0.3% is what the regulators require, but you want to have 50% more than that. So you're actually going to set aside 0.45% of this 100,000. If you buy the BBB bond, you're going to have to set aside 4% times 1.5. You're going to have to set aside 6%, $6,000 in case that bond goes insolvent. If you buy the high yield bond, you're going to have to set aside 30%, $30,000. So it sounds like, why would I ever buy the high yield bond? I got to set aside so much money, but we'll look at that. When you sell the policy, you have a capital charge just for selling the policy of 1% times 1.5. You have to set aside $1,500, but it doesn't matter what asset you buy, you have to set aside $1,500, okay? So here's your capital charge. For the treasuries, the asset charge is 0. The mortality charge is 0 because this is an annuity. There's very little mortality risk. So C1 risk is asset risk. C2 risk is mortality risk. And C3 risk is interest rate risk. So for the treasury, you don't have any credit quality risk. None of these policies have mortality risk. And you have to set aside $1,500 just because of the nature of the product. So there's how much net worth you have to set aside. And for competitive reasons, you want to pay these people 4.7%. So that's what you want to pay them. Your expenses are 1.4%. So you want to pay them $4,700. You have to spend $1,400 just for your employees. If it's the BBB bond, you're going to set aside an additional 0.1% for a haircut. Now, how do I explain the haircut versus the $6,000? All right, let's understand the $6,000. The $6,000 capital charge is like that 1 in a 100-year event of an insolvency. The haircut is what you expect every year on average. Okay, you see the difference? So on average, you expect to lose about 10 basis points because of insolvencies and downgrades. But every 100 years or so, you're going to have a really bad year, you're going to lose $6,000. Okay, so the capital charge is that 1 in a 100-year type of hit. Their haircut, but how much you expect to lose every year on average. Some years it'll be 0, some years it'll be 0.3%, but on average 0.1. For the high yield, you have to set aside a haircut of 2%. Your return on equity target is 15%. All right, so we got just enough time to do one example. We'll do another example Thursday night. So how do you set this up on the exam? And most students get this right because it's a pretty straightforward problem. So you start off with revenues and then net revenues. You have the haircut. Then you have your cost of goods sold, which is what you're going to pay to the customer. Then you have your operating expenses. Then you have your net income. So let's think through this. So the treasury is going to pay you 5%. So if you buy the treasury, your earnings are $5,000. Everybody with me on that? $100,000 times 5%, you're gonna have $5,000 in interest. No haircut, because we hope the Treasury doesn't default. You're gonna pay your customer $4,700. Remember, that's what you need for competitive reasons. I remember at UTSA, it was very explicit. UTSA called all, they had, I don't know if you ever realize companies do this. They hire people to call all the competitors and see what their rates are. So UTSA's goal is to always be in the top 25%. And that's what that 4.7% was for them. Okay, so it was, they knew they had a very specific goal. So $4,700, and their expenses is 1.4%. So they make $5,000. They pay their customer $4,700, and they pay their employees $1,400. You see why they can't buy treasuries? There's no way to be competitive in treasuries. When the 2008 bill came out, and they had what they call, I don't know if y'all heard of the Volcker rule. Y'all remember the Volcker rule? So the Volcker rule said banks can't be investing on their own. Banks shouldn't be buying stocks and bonds on their own. They shouldn't be risking their money with money that the government's guaranteeing for their customers. And so the Volcker rule was going to say, JP Morgan, you can't be buying stocks and commodities and corporate bonds. You can't be taking risk with money that the government's backing. Well, there was a fear that Volcker rule was going to apply to insurance companies as well. And they were going to tell life insurance companies they could only buy treasuries. That was going to put the whole business out of business. And so they had to fight that pretty hard. But what about AAA bonds? So the AAA bonds paying 620, and which is crazy. A AAA bond would never have 125 basis points spread over treasuries. So I gave you a really good AAA bond. But even then, your haircut zero, crediting's that, expenses is $1,400. You make a profit, but remember on the AAA bond, you're having to set aside $1,950. So what's your return on equity? $150 divided by 1950, your return on equity is only 8%. What return on equity did you need? You needed 15%. So you're not going to make it there. And I should have done it differently. This probably should have been 5 1/4. With 5 1/4, it absolutely doesn't work. You don't even make money. So I should have done it. You know, AAA bonds only make slightly higher than treasuries. So life insurance companies do not buy treasuries. They do not buy AAA bonds. They buy almost entirely triple Bs and high yield, almost entirely exclusively. Let's look at the triple B. So you can make 7 1/4. So 725. You have a haircut, $100. You're going to take that out. I'll talk about that more on Thursday. Credit rate's the same. Expenses are the same. There you make 1050. You take 1050. Divided by 7,500, and you have a 14% return. What did you need? 15%. Not quite good enough, but getting pretty close. And then we do high yield. You think high yield? No way high yield's going to work. Well, you're getting quite a bit of income, but you're going to subtract $2,000 because you know you're going to have defaults. So you can just subtract quite a bit. But there you make 4,900. So even with that high capital charge, you still make over 15%. So the high yield is the only one that works. All right, so what's the solution here? Well, the solution is not 100% high yield. Why is that not the solution? Because there's no way any life insurance company is going to put all of their money in high yield. It's just not going to work. In fact, 10% is probably max they can do in high yield. Why is that? Well, if you think about it, for $100 in bonds, you have $10 in net worth. So if you put 10% in high yield, how much of your net worth is in high yield? 100% of it. Rating agencies do not like you to have 100% of your net worth in high yield. It's just too risky. So your answer on the exam is going to be high yield is the only one that works, but there's no way you can put all your money in high yield. So what are you probably going to do? You're going to put some in a lot of it in triple B. probably 90% triple B, 10% high yield, and you're just going to miss. If you do that, you still won't get your 15%, right? But you just don't make your answer. You're just going to put all your money in high yield. It's just not possible whatsoever. Especially in a year like 2008, when high yield absolutely blew up. There are a lot of life insurance companies that just with the 10% that they had, saw their net worth go negative because the high yield blew up so dramatically. I mean, some of these bonds were down 70, 80% in 2008. It was pretty crazy. All right, so the question's going to be, what could they do? So let's think about it. So one thing you could do with this is what my company did, is they said, hey, John was our investor. John, can you get us a little bit more on triple B? Could you get us like 7.5%? And John says, well, okay, I can try. Would 7.5% be enough? Yeah, that would be good. You don't even need 7.5%. Just give us 7.3%. There you go. We got it. Maybe. I don't know if that's enough. Not quite. But and John says, okay, I can try. Now, how does John go from 725 to 735? What does he have to do? One thing you say, he's just got to try harder. Try telling John, just try harder, because what John's going to say, hey, I'm working hard. It's not like I'm going home at 2 o'clock to play golf or something. You know, I'm working pretty hard. Don't tell me try harder. So what can he do? So this is something you always have to know. When you ask a bond manager to get a higher yield, you are asking her to do what? To take more risk. When you tell John, hey, I need to get 735, it's okay, well, I can buy some triple Bs, but they're going to be like triple B minus. I don't get charged more on the capital charge, but I'm buying you more dangerous bonds. You're taking more credit risk, which means what should they do? They should probably increase the haircut a little bit, but they're not going to do that. So they're a little bit playing games. So that's part of the problem. So increase your revenue. The only way to increase your revenue, other than telling John to work harder, is to take more risk. Now, what about the haircut? We'll talk about the haircut. We could reduce the haircut. We could say, you know what, 10 basis points. No, it's really 7 basis points. We could do that. But you're just kidding yourself there. How much do you really need? Just use that number. If it's 10, use 10. If it's 7, use 7. But don't reduce it because it helps you get the numbers. So the actual numbers can be whatever the actual number is. Now, the crediting rate, we could reduce that, couldn't we? Reduce that down to 4.5. That helps us. We don't have to go that far. We could go to 4.6 probably. And that might help us. I don't know if that's the right answer or not. Yeah, that would work. But what's the marketing people going to say? We're no longer in the top 25%. Sorry. Right? So then you get from competition. We could have reduced expense load, but again, the question is, what's our expense load? Someone say, well, if we stopped having these banquets every month for $50,000, we just had one a year. Well, that's good. Yeah. If you're wasting money, stop wasting money. That would be an easy solution. But at some point, if you're cutting your expenses, you're going to hurt the service quality. You're going to do something that's going to mess up somewhere else. So yeah, always get your expenses to where they need to be. Always reduce your expenses when it makes sense. Don't waste money. But there's a limit to what you can do there. We could reduce our ROE target to 14%. That would work. But if you do that and the stockholders need 15% and you're only going to make 14%, what's going to happen? Your stock price is going to fall. So what are the solutions? And I actually want you to have that discussion. We'll do this more on Thursday night. I want you to have that discussion on the exam. What are your options? But if you notice in the options, I'm just going across this. How can I get more investment earnings? We'll take more risk. Can I reduce the haircut? Well, it needs to be whatever it is. Whatever the number is, that's what I'm using. Can I reduce crediting rates? You can, but you can be less competitive. Can I reduce expenses? Well, if you can, do it. But you should be doing that all the time anyway. Can I reduce my capital charge? That one we haven't talked about yet. or can I reduce my return on capital requirement? So each one of those is a debate. So we'll do this. I'll give you another example. I have some examples out there that are actual previous exam questions. So we'll work through one of these on Thursday night. We'll go through them in more. But the exam's in here on the 6th, which is, I think, Tuesday, isn't it? So I'll be here a little before 7, but it's never worked. There'll probably be a class in here, so we probably won't be able to start early. We'll see. Right. So we only have one problem. Just spend a little more time on is, so what I want to do is work an actual exam question from a prior exam, so you can see exactly how it's structured. So someone walks in with $100,000, buys this annuity, and you've got to figure out which of these assets. And you notice here, I didn't even bother giving you the Treasury and AAA because you just know it's not going to work. You can't possibly make it work. So it's between triple B and high yield. You can see I wrote this back when interest rates had fallen. In fact, interest rates are somewhat above there, although I don't know if you'll notice. It's been pretty amazing. My friends over at Victory are probably pretty happy right now. And 10-year rates, if you notice, it's been a really nice little rally here. Look at that. We got up to 420. We're already down almost to 3.5. So that's 70 basis points. And you really just a month and a half. That's a huge rally for bonds. So maybe we're getting back down to these numbers, but the AAA, high yield is definitely higher than that. Triple B is probably a little bit higher than that. So they're going to put 100,000 in. They have to have so be real careful here. I'm using C3 and C1 in here. So let's be real careful on this. All right. So C1 is going to be applied at 4% to the 100,000. But is it really 4%? So let's look at that. C1 risk is 4% and 20%. C3 risk is 1%. Those are all going to be applied to the 100,000. But at what degree? So here's a really key, that RBC target ratio. These numbers are at the 100%. If they wanted the risk-based capital to be exactly at the regulatory limit, but they actually want to have 50% more, which means 4% is really going to be what? Really going to be 6%. And 20% is really going to be what? Really going to be 30, and then 1% is really going to be 1.5. Okay, so you got to make sure you know to put those two things together. All right, so I'm going to work it in order that I would work it if I were you. So for me, step 1 is calculate the capital requirements. So C3, we already know. C3 is going to be 100,000 times 0.01 times 1.5. That equals 1,500. Everybody see where I got those numbers? 100,000 is how much is being invested. It'd probably be 100,000 on the exam, but don't just assume that. The C3 charge is 1%, but we want 50% more than that. We want 150%. So that changes that. So 1% times 1.5. So there's my C3 charge. And that's true whether we're doing a triple B or the high yield. C3 is the same for all of them. C1 for the triple B is going to be $100,000 times 4% times 1.5. And that's going to be $6,000. And then high yield be 100,000 times here the 20%. It's going to equal 30,000. Everybody's with me on all those? So the reason I'm giving you this is it looks a little different than the Excel. So I want to make sure you know what number means what. So this is a really pretty critical number that you know what to do with that. You notice there's nothing in here that you don't use. There's no fake numbers. I'm not going to put it in there. So if you're not using every number in here, then you did something wrong. All right. All right. So the capital charge for triple B is going to be 1,500 plus 6,000, 7,500. For high yield, it's going to be 1,500 plus 30,000, 31,500. All right, so that's step one. Step two, build the income statement. So we need 1, 2, I think 6, 3, we'll see. So we're looking at the triple B, we're looking at the high yield. Anybody remember the columns? Think about an income statement. What comes first? Revenue. So that's going to be our investment earnings. And then net revenue. So what comes next? Your haircut. Because that's what you're going to take out of revenue. So that gets you to your net revenues. Then you have your cost of goods sold, right? Which for insurance is what? The crediting of interest. Then you have your operating expenses, and that's just your expenses. And then you get your net income. Oh, don't do that. I didn't do that. Okay, well, we'll wait for it to come back on. All right, so how do I get the revenue? $100,000. Triple B is going to make 3.85%. So $100,000 times 3.85%. So that's going to be 3,850. Hopefully this thing comes up here pretty soon. Boy, I had technical problems last class too. This just me one night. Last class I couldn't get PDF to work. You would think that would have been a pretty simple thing. Well, while I'm waiting, let me get attendance real quick one more time so I don't forget. Jonette, Michael. Someone came in, but I'll maybe not. Oh, Logan. We get Logan. Oh, and Angela. Okay. Any questions about the exam while we're waiting for this to come back up? I will put an exam review out there. Oh, I forgot to tell you, I've decided to take out the first question with all the symbols. So I've decided if you can do the hard pricing problem, you know the symbols well enough for our purposes. I like that question because it's a good logical question, but some students just freak out on it. So I'll just leave it out. So you'll get enough practice. If we have enough time tonight, assuming we can get the system back, we'll work that one long problem that I gave y'all last time or 2 weeks ago or 2 classes ago. All right, so everybody see where I get that 3850. Everything's times 100,000 and we're going to make 3.85%. So that's the nice thing. You're always multiplying by 100,000. On the high yield, it's going to be the 100,000, but by 7.8%. So that's going to be $7,800. The haircut's pretty straightforward. 10 basis points for the triple B, 200 basis points for high yield. And remember the difference. This capital charge is a worst case scenario. Something happens once in 20, 30 years. This 200 basis points is what you expect on average to lose. So that's the reason we have these two different numbers. So 10 basis points, it's $100, and then $2,000. So our revenue is going to be 3850 minus 100, so 3750 and 5800. That's our income amounts. Crediting is pretty straightforward. They just say crediting rate 2%, so that's going to be the same for both of them. And then expenses, 1.2%. That's a pretty low expense load for an insurance company. All right, so there's everything. We use every number. We use the 100,000. We use the 1%. We use the 2. We use the 1.2. That's the only one we haven't used yet, but that's going to be our benchmark. All right, so now we just have to do net income. Oh wow, okay, 3,300. So is that 550 maybe? Can someone do the math for me? 550, okay. And then 42, so 3,600 maybe. Someone check me on that. That look right? We have actuaries in the room. That should have it. All right. So, and then step 3 is the ROE calculation. So for triple B, going to be 550 divided by 7,500. You go back up to your capital requirement. And for high yield, 3,600 divided by 31. I did that right. That seems too high, but did I do that right? 2,600, right? Okay. Is it 26 or is it 36? It looks. Oh, it's 52. I couldn't. I did 4,000 plus 200. 4,000 plus 1,200. Okay, 52, 26. All right, that makes more sense. All right. Can someone give me these numbers? Yeah, it's not gonna bring up a calculator. No takers. Yeah, sorry, that was a mistake. All right, I'll do it myself. So 733,825. Y'all remember that? 733,825. I say 25. All right. Now that's the math part of the problem. So you do have to make one recommendation. How could you word this? High yield meets the 8% ROE target. We cannot put 100% in high yield, even though triple BB is below 8%. Most likely, our limit on high yield will be about, what do y'all think? How much? Maybe 10% for most insurance companies. Why? Because their net worth is about 10% of assets. So if you put 10% in high yield, you have 100% of your net worth. And that's the way the rating agencies look at it. They don't look at high yield a percentage of assets. They look at high yield percentage of net worth. And they want to know how much is your net worth exposed to high yield. But this is still very, very risky. Insurance companies are very, very risky. They take a lot of credit risk because triple B is pretty risky as well. If you buy a bond mutual fund, you know, they have a lot of triple B, but they're probably going to have some single A and double A as well. Insurance companies buy almost no single A, double A. Everything is triple B and high yield. It's the only way you can get this to work. Most likely, it will not be able to achieve their target. And you could even do the math yourself to say, what if you have 90% in that and 10% in that? That still only gives you about 7.5, 7.4%. You're not even close. So that 10% high yield is not going to get you anywhere close to the 8%. So they're probably not going to make the 8%. All right, questions on the math. We did use every single number. I gave you the 100,000 twice. Right. Isaiah? For which part? Y'all want me to work another problem? Yeah, I feel like you got it. You want one more? All right. It will be just as straightforward on the exam, though. I don't throw any curves, and most students do pretty well on this. There's some math errors out there, but most do pretty well. Now, don't get into the weeds of this. Always step back. This is, if you understand what we just did, it gives you amazing power in interview. This is really good. I had a former student email me from Austin. He was interviewing with an insurance company. And this is all this, I gave him this problem actually. He had no background in annuities, and it was an annuity pricing. It was exactly this. This is his job. He was supposed to, they gave him a problem to work, and it was, what should they invest in? It was exactly this problem. So I sent it to him, and the problem was missing a lot of stuff. Nothing on haircuts, nothing on duration and mismatch. You know, it was a really poorly worded problem, but I gave him everything I had, and it was like, yeah, I don't know if I can get you ready for this in 2 hours, but this is what I showed him. I actually had him go watch the video where I do this problem, because it really does help you understand what an insurance company is up against. You got it, Isaiah? All right, let's see if it can work. Forget it where I put another one. Yeah, I didn't put it there. This says examples, but I only see one, so I may not have put two in there. Yeah, there's only one. All right, sorry about that. Boy, this has not been a good night technology wise. Let me find one real quick. All right, so the second part of the question is, if they can't meet that standard, what can they do? So what you need to do when you answer that question is essentially go through that income statement just like we did, and think about it in terms of what would they have to do under each one of those. All right, so the first thing in there was the investment income off of the bonds. How can we get that number higher? We talked about it last class. So take more risk. That's about the only way to do it. So you say, hey, you buy triple Bs, but buy some triple Bs with higher spread. Well, why did they have higher spread? It's because the bond market's just not paying attention. And say, oh, whoops, we paid too much for these bonds. No, it's because they have more risk. So yeah, you can tell your bond investor take more risk, but when you tell them to do that, I mean, you get more yield, but when you tell them to do that, they're going to take more risk. That happened at UTSA. I thought it was hilarious. The guy who had experience, I didn't think of that as hilarious, but they told the investment manager, why can't you take more risk, take more risk, take more risk? This was like in 2006, 2007. So he did it. Then it all blew up in 2008. And they're like, why did you take so much risk? Man, who taught you how to do this? You're an idiot. They were all over his case, but he did exactly what they told him to do. And he was telling them, hey, if I'll do it, but and they were actually telling them, why don't you buy some high yield? You know, we need some riskier bonds so we can get on more spread. They did exactly what they told them. It blew up, and then they actually hired a firm to come audit him, figure out why he made such big mistakes. And his big mistake was listening to the people that were auditing him. All right, I'm almost there. Let's see. Sam 2. Let's see if this will work here. Hopefully it's a different problem. Does that look like a different problem? Yeah, that's a different problem. Okay. All right. The numbers are the same because I'm getting them from the official regulatory risk-based capital. So the 1%, 4%, and 20 are the same. What's different is going to be the target. Here it was the same, 150, but don't assume it's 150. It could be 200%, it could be 125%. It's going to be, you know, USAA is probably 250, 300% because they want to be highly rated. Another firm, 125 might be enough, but so do watch that. 1.3 is the crediting rate. Expense load is a little bit lower. Haircuts are the same, just because I've been using the same haircuts based on history. So step 1 is the capital charges. So you got the C1 risk is going to be exactly the same, $100,000 times 0.01 times 1.5. Going to be that same 1,500. And these charges are going to be exactly the same. There's no difference here, is there? C1, triple B, 100,000, 0.04, 1.5 equals 6,000. So that's exactly the same. The only reason it won't be exactly the same on the exam is if I give you a different RBC target amount. All right, so I'm sorry, this is C3. Excuse me, C3 risk, C1 risk, and so total capital required, triple B, be 7,500, yield 31,500. Right, any questions up to there? And then step 2 is build income statement. Forget what I did. I think it was 6 and 3, but all right, so we have triple B bonds, we have high yield bonds, we have revenue, haircut, crediting, expenses, so we're going to make 3%. Boy, this is another time when interest rates are really low. This is definitely not true today. Triple B are probably well above 4.5%, 5%. So 3% and 6.7. So 3,000. You can see why I make it $100,000. Makes it a lot easier to do the math. 6,700. Their haircuts can be the same as before, probably 100 and 2,000, I would guess. So how do we get these numbers? So what I did, I went back and got a default study back the last 20, 30 years and just look at the average defaults per year. And that's what I use. You could reduce this sum for recoveries, and I think I might have actually done some of that So this is a little bit on the high end, but not radically so. And you want to have a little bit of conservatism there. Crediting seems pretty ridiculous, but they're only going to pay 1.3%. But that's how low rates were. The last time I checked on annuities, there's some up above 4% now. So annuities are actually have been more responsive to interest rates than bank CDs have been. So if you've got family members that are buying bank CDs, I know it sounds crazy, but you might tell them, go look at some of these EGAs life insurance companies are selling. You get the tax deferral and you're probably getting a better rate. So unless they're too old to buy them, you at a certain age, you can't defer. Then your expenses, this firm's a little bit more efficient than the other ones. So $1,100. So is that 500? Let's see if I can get this one right now. 44.23. All right, someone check me. I'm usually good at math, but when people are looking at me, I can't do it. Anybody double check? Look right. 500. 14.25. 33, 43, 44, 20. That looks right to me. All right. Step 3, calc ROE. So 500 divided by 6, 7,500. 300 divided by 31.5. Oh, that wasn't good. So 667 and 373. 667. And their target ROE was 7%. So how close can we get with these two bonds if we do 90% there, 10% there? It really doesn't help us all that much. So you'd have to get a lot more out of the high yield for it to really help you there. So, and so what's our recommendation? Well, it's exactly the same as before. There's no difference. So high yield meets the 7% ROE target. You can't put that much in there. It's below 7%. They're probably just not going to make the 7% target. So let's go back in. Let's talk about it. So revenue, what can you do with revenue? Stretch. More yield means more risk, probably more credit risk. So that's the first one. Haircut. Use the number that is correct. That's about all you can say there. What is the right number? There's nothing you can do to reduce that number other than making a different assumption. It is an assumption. Firm cannot change. There's nothing this firm's going to do that's going to change defaults, average defaults by different credit qualities. I mean, you can tell your bond investor, hey, and in fact, my CEO told us this. It was kind of shocking. I got approval to do high yield. So I go back and tell the bond guys, and they're really excited. We can do high yield. And then they had defaults. And the CEO said, you can do high yield, but you can't do high yield if you're ever going to have defaults. And you're like, okay, well, shut that down because you're not going to buy high yield and never have defaults. And we're like, yeah, he forgot to tell us that part. So you will have defaults if you do high yield. And so the haircut, you got to be honest. You can't just assume you're going to make 6.7% on these bonds. You will have losses. Okay, what's the next one? Crediting. All right. So what do we say on crediting rate? And reduce it, but then what? You harm your competitive position. Then you have to ask the question, well, why are competitors better than us? Are they taking more risk? Are they not meeting is our ROE target too high? We'll talk about that. But for some reason, when we credit the rate that we think is competitive, we can't meet our ROE standard, our targets. So that one's an issue. What's the next column? Expenses. More efficient. The answer to that is yes, all the time. It's not like you said, hey, let's waste money. Oh, you know what? I'm making an ROE standard. Okay, well, let's get more efficient. That's not how a firm operates. Obviously, you're going to be as efficient as possible. If you cut too much, going to harm morale and service, etc. So you cut expenses where you can, but if you cut too much, yeah, you're just causing harm. So this is always a debate. Where are we spending money? The debate at UTSA, and it's probably true of all large companies, is the bad guy was always corporate. Why is corporate allocating all these expenses to us? Why do we have to pay for the publishing department or whatever? So everybody's complaining, but they all use these services. So, that's kind of the debate we had. When I first started at UTSA, that was the debate. I went to this meeting with like 40 people in the room, and the smallest subsidiary said, we're going to stop using UTSA's publishing services. We're going to go outside and use our own. And we pointed out that what you're paying it for UTSA is not like it costs UTSA. You have all those overheads. So if you go outside, you're actually harming the company, and they say, we don't care because we don't want to pay the higher enough. Those are big debates. So you do have the corporate allocation debate on expenses, but ultimately it's left pocket, right pocket. You can't do too much on that. But yeah, if you can cut your expenses, cut them with that if it doesn't harm the business. So what comes up next? The capital requirement. Reduce the 150% target. What would happen there if they did that? Risk being what? Get downgrades. 150 gives you your BBB rating. If you do 125, they may downgrade you to BB, and then you're going to be one of those high yield bonds yourself. So you can't do that. What else do we have? Reduce the ROE target. It reflects the required return to stockholders. Risk drop in stock price. There is no obvious solution to these issues. What will a firm actually do in real life? Well, they're probably going to credit the rate they need for competition, and then they're going to try to make it up in another product. What we did, I'm giving you all UTSA stories. What we did at UTSA is we usually try to take it out of one of the life insurance products because they were really profitable. So you know what, whole life doesn't need to make so much money. So they might try something like that, or they would compete with each other. So they say, you know what, this annuity is really selling well right now. We got to keep the rate up. Let's take some of the credit rate away from this other annuity that's not selling as much right now. And so they kind of kid themselves like that. But I used to go to these meetings. They were interesting meetings. And it's this big debate. It's marketing versus the actuaries versus the investment people versus the accounting. They're all debating finance. They're all in the room. And they're interesting debates. And at the end, they compromise. They know each other extremely well. One of my good friends, she was the CFO at the time. I love that the way she did things. She always knew what she thought because it was on her face. If someone said something stupid, you knew someone said something stupid. You had to just look at her. And it was wonderful. I love people where you know exactly where they stand, and she would tell you exactly where she stands. She would like roll her eyes. Someone said something, but she she knew this politics backwards and forwards. She knew exactly when the decision was made, how it was going to flow through. So she became very powerful in that meeting because she understood every aspect, marketing, the actuary. She knew all the different parts of it. You need someone like that in a meeting like this to really understand the dynamics of the business. This is a very complicated business. So usually what they'll do is they'll play one product off of another product. We used to call it competitive resources. So, okay, our life insurance products, they're making an extra 20 million. How much do we need to get this annuity where we need it? Oh, we need 5 million. Okay, we're gonna shift it from there over to here. And they would just make sure the company makes its return, even though the product doesn't. Now, how good are they at this? I was just amazed with the actuaries. They couldn't just tell me how profitable each of these products were, but they could tell me on life insurance how profitable the product that we sold in 2017 is versus the product we sold in 2018 versus 2019. It was just ridiculous how accurate the actuaries are. All right, questions on this. This is what I was telling the guy who's interviewing the job. This is what you really have to understand for an insurance company. These are the dynamics. And there's no obvious solution, but you play with these as much as you can. There might be a combination on these. You might say, hey, can you get us an extra 5 basis points maybe to help out a little bit there? Maybe we don't quite make the 7%. Maybe we make 6.9. We make it up on the life insurance side or something. You know, those are the dynamics that they're playing with. Is that enough? Y'all feel good on this one? This is usually a fairly straightforward question. All right. Let's look back at this one problem that I gave y'all. I don't know how many of y'all tried it. It was the Garrett life, wasn't it? And I told y'all to look at. Does that look familiar? I don't know where Garrett came from. It was probably a quarterback in an NFL that maybe for Cowboys or something. Y'all want to work this problem real quick? Give you some practice. So where's my mortality table? All right. I did put this out on Blackboard, so you do have it. Does anybody know the button for wrap text? I think someone told me once before. Yeah, you might know. Save me one step with the keyboard. All right, let's just look at the problem. So remember what you're going to do. You're going to start off with the cash outflows and figure that out. Then you got to figure out where the premium payers are. So it's essentially just breaking up into the pieces. So there's life insurance company, and y'all tell me if we worked this before. I'm pretty sure Garrett was the one I told y'all to look at. Develop a new product. It's issued to pay people age 30. You pay a premium at age 30, 35, and 40. So there's our premium payers, L30, L35, L40. It pays a lump sum to anyone alive at the beginning of age 90. So we need L90. They're going to get $2 million. Don't know what that is. A lump sum of $4 million, anyone alive at age 95. So what is our end starting to sound like here? You remember, if it's at the beginning of the year, is it going to be 60 or is it going to be 61? It can be 60. Okay, if it were a death benefit, at the end of the year, it'd be 61. All right, so keep that in mind. If it's livers, it's just subtract. If it's dyers, it's subtract +1, right? And then even the L99s, I mean, they're not, we have to do L99s because 100% of them are going to die. And they only get 1 year to enjoy it, but we're going to give them 10 million so they can really enjoy it a bunch. So you make it to 99, you're going to get 10 million bucks, and you would have made 16 million bucks. Your family's really happy. You went from being, your net worth was 50,000 bucks at 89, and suddenly you're a millionaire, and your family's like, wow, I'm sure glad you made it another 9 years. All right, so there's what we need. Let's get our L's. L30, L35, L40, L90, 95, L99. What is our rate? Our rate is 4%. Anything else I need? I think I got it all. Are these starting to look kind of easy? If they're doing the ones last week, they're starting to kind of get there. Is anyone like, I have no clue how to do this? Hopefully not. So the first thing we're going to do is figure out the present value of outflows. That's where I always start. So we're going to have L90 times $2 million divided by 1.04 raised to the 60 plus L95 times $4 divided by 1.04 raised to the 65. You'll let me know if I make an error. Plus L99 times 10 million divided by 1.04 raised to the 69. That look correct? Errors, issues? Let's see this real quick. 90 times 2 million divided by, I'm just going to type it, raised to the 60 plus that times that divided by 1.4 raised to the 65 plus that. Okay, I did it all right. Premium at the beginning of age 30, 35, and 40. It's going to be the same premium. So isn't this isn't that hard of a problem, really. Your denominator is pretty straightforward. It's going to be L30 plus L35 divided by 1.04. Now here, what's my time? So 30 is 0. So if you have to, take out your fingers. 30 is times 0. 31 is going to be 1. 32 is going to be 2. 33 is going to be 3. 34 is going to be 4. Is that right? So L31s don't pay, but if they did, it'd be 1 year from now. 32, 33, 34, 35. So it's 5 years. Everybody agree with that? It's not 6 years, it's 5 years. Plus L40 divided by 1.04 to the 10th. Right, so L30, 35 divided by 1.04 to the 5th. L40. So the premium would be $7,000. That seems awfully low, but we'll test it. How is it possible someone's going to pay $22,000 to get $16 million? That sounds like a really good return. But why is it? Because you have 294,000 people paying to 8,000 people. So that's why you're getting these huge payoffs. So let's try it. We'll see if we can set it up. If we could do this in Excel, I would almost even ask you to create this table. But since we can't do it in Excel, so we'll start off with age and then time. So age is 30. That's times 0. Inflow outflow and ending value, and we ended up beginning. So we start with 0. We have an inflow of 7,000 times L30s. So we have an inflow of quite a bit of money there. No outflows. So our ending value is beginning plus inflow minus the outflow. That's the ending value. But if it's the ending value as of time 1, this is where you got to be careful. This inflow happens at the beginning of the year. So our ending is going to be that, and be our beginning. And when do our outflows happen? They also happen at the beginning of the year, don't they? So all of this is going to make 4%. So my beginning starts there, all right? What's my inflow? Nothing, nothing, ending. Need to go to 99. Okay. What's the next thing that happens? You remember? 835, another premium. So $7,000 times L35. There's our premium there. Not quite as high because a few people have died, but not that many have died. We can simplify this sum by getting rid of the decimals. All right, and then the same thing at 40. 7,000. And I don't know if this is going to work. I was lucky last class that I got them. We'll see. All right, we're up to $2.8 billion, and that's just going to sit there for a long, long time, isn't it? And then we come in as age 90. It's 90. Whoops, that's an inflow. Okay. Throws in here age 90, so this is an outflow. I did subtract, right? So I need to do as a positive number. So we're going to pay 6,000 people $2 million. And I needed to increase by 4% because I'm going to pay it out at the beginning of the year. So I'm going to lose 4% of my earnings there. Okay. Then age 95, we're going to do the same thing again. Except for it's only going to be $4 million this time. There we are there. Does it look promising to anybody? Age 98. How many people you think are alive at the beginning of age 99? Might be 111 people, maybe. I'm really glad. How round is that number? Well, Bill Gates thinks it's not quite that round, but who knows why he messes that up. But anyway, we'll come over here. Got 111 people making 10 million. At the very end, Bill Gates thinks there's something there, but there's nothing there. Yeah, I don't know why he thinks that. So it looks like it worked. Looks like I'm 100%. That's a lot better than my secure analysis class. So I'm betting pretty good there. Why do I do this? Because I want to get thinking these are really quite simple. Present value of the outflows, that's easy. That's just how many people get paid times how much they get paid, and you discount it to the day. That's really, really simple. The only thing that's weird about insurance is those premium payers, but then you notice the premium payers is the exact same math. You don't do anything different. You just take the premium payers, discount them, and you've got that, and you just take the difference, and it works magically at the end. So it shouldn't be too difficult. I forget what problem we did last time. We did one of the sincere ones. But if there's one out there that I haven't worked that you want to work it, and email me and I'll send you the solution. So I can't remember which ones I don't remember which one we did in the last class. It's probably up there. Probably. It's joint live. Longevity life. Is that this one here? No. So I don't know where I did that one. I can't remember. Let's see what the previous one was. No. So yeah, I've worked at least a couple of them for you. So, and this will be out on the YouTube. So what could I do? So you notice the ones I've shown you have been lump sums of livers. I could pay death benefits. The reason I don't do death benefits is I really want you to see the value of survivorship. It doesn't really make sense here to pay death benefits to these people. Because why are we paying them? Because they're living so long, they need the money. If they die, it's like great, you know. You don't want a 97-year-old's family making a fortune if he dies. That's not good incentives. You much rather, and this is pretty cool, right? Hey, if you make it to 99, we make 10 million bucks. You know, you can die at 99 in 3 minutes, but if you can just make it to 99, that's kind of a good incentive. We'd like for you to live an extra year. So doing a death benefit here just is like, man, I hope grandpa doesn't make it to 100. That's a little more morbid. So I tend to do it as livers. But I could combine this as life insurance and annuity. I could say, hey, and I've done that with a few of them. I could say anybody that dies at 50 will get their premiums back. That'd be a strange policy. So the people who live to 51 but die at 89, they get nothing. But I could do something like that. And then you'd have to do if I say dyers at 60, then your end now is going to be 60 minus 30 plus 1, because death is always at the end of the year. So if I put dyers in there, that's the only adjustment you got to make. If it's all livers, then you just subtract all the way through. The premium payers, you notice on the premium payers, that's always subtract. That one's pretty straightforward. They're paying premiums at 40 and you're starting at 30, then the end is 10. So that one's always really, really simple because it's always beginning of the year. So that's not an issue. So the only time you have to worry is if I give you dyers for some reason, there you have to adjust your end slightly. It's not like you're going to lose all your points if you forget to do that, but you will lose a few points if you do that. So how many are going to get this question 100%? Right. All of y'all, hopefully. So the first time I did this, seriously, only one student got it right. 2 or 3 kind of got something down. Half the class left it completely blank. So we're getting better and better and better. All right, so you have the exam review out there. You know what it's going to be. The exam review is incorrect because I'm not going to give you the first questions. I'm going to just leave them out. Some of y'all might find that upsetting because you're really good at that question, but the majority of class bombs that question. So oh yeah, we're not going to do that. All right, so we ran out of time, so we're not going to do that question. So I got to put a new exam guide out there for you. We're not doing these first 2. Thanks, Bill Gates. All right, so we're going to do these. I'll probably throw in a few extra of these just to give you a little bit more chance to spend some time on them. And then the tough question, probably what I'm going to do is, since we're getting so much better at tough question, I'll probably increase the points on tough question, because the last exam, students did much better on this question than they did on this one. So I'll take probably 5 of those minutes and put it into here. So this will come out to be 40 minutes. The joint life, we'll probably keep it at there, and I'll probably take this one up to 25. So that's probably up, no, 20. No, 20. Let's see, 40, 50, 25. All right. So that's going to be the exam. I'll give you a new exam guide. We ran out of time on this, so I won't do that. So it's actually going to be a much easier exam because it's going to be almost all math, which most people prefer anyway. All right. There are YouTube videos. So on this one that you have to go through all the steps. There's a YouTube video that shows that. There's a YouTube video. Now, joint life, I'll have to say in previous classes, joint life has been an absolute disaster for some students. Don't let it be a disaster. It's not that difficult of a problem. So practice it. You have more time to practice it. All the time you're going to spend studying for this, make sure you put it into the joint life. I think when you see this part, it's going to come back to you pretty quickly, especially if you understand this one down here. So it'll be good shape. So you got a good example on the joint life. And you have a YouTube on the ALM questions. So you have good YouTubes and you have the class videos on the more difficult questions as well. Right. And the other thing to remember is on these, I only make you calculate 3 of them. There's only 3 of them. You have to actually calculate the numbers. Most of them you just can put the symbols in. There's only one of them, the endowment, where I make you go through time 0, time 1, time 3, and all that to come to 0 at the end. So you have to calculate the premium here. You have to calculate the premium here. And there's maybe one other I'll have you do that. And then on joint life, you have to calculate. Remember, on the joint life, you need to be able to calculate it and compare it to buying 2-term policies. So make sure you know how to do that, but that's in the video. All right. And then remember, on the ALM problem, you need to discuss what can you do if you're not meeting the ROE target. So provide the options there, and don't make this too short. You know, give me some meaty answers there. This is a little too summarized, so put it into some good words there. Y'all understand all of these, so that you can flesh them out, so you're not just word for word. So don't give me word for word on this. You know, flesh it out. All right, are y'all ready? Y'all got it? So what did we leave out in the notes? Well, the discussion on ALM we missed. I didn't get to tell you why life insurance looks like a short strangle, but I think I can show you real quickly, because it is very, very important in interviews that you understand this. I actually showed it to the guy who was doing the interview. So I saw this the first time in a life insurance presentation from actuaries. When our CEO saw it for the first time, he absolutely freaked out. So what they would do is they would run models of their business, and they'd run the liabilities and run the assets under different interest rate scenarios. So they're starting right here at 6%. What happens if rates rise? If rates rise, the assets fall and the liabilities fall. If rates fall, the liabilities rise and the assets rise. And then what they did is they ran a graph of the difference in these. And that's the graph that they showed. And if you know what a straddle is, it looks like this. Have you ever seen a straddle or a strangle? Any of you are familiar with options? So straddles, when you sell a call option, you sell a put option. You get all this money. It's wonderful. And you're really happy as long as what you sold the options on doesn't move in price. If that's the case, you get to keep all the money. But if it moves in price, volatility kills you. That's exactly what an annuity is. Now you might say, well, it doesn't hurt them so much up here, but as rates keep rising, this thing kind of winds itself around like that. So if rates keep going up, it looks exactly like a straddle or a strangle. And our CEO saw that and said, why in the world will we ever sell this product? Well, it's because right in here, you make a lot of money. They're very, very profitable. But he's like, yeah, but I can destroy the whole firm, and you can. That's why I'm saying it's really a dangerous time to be selling annuities in the life insurance industry, because interest rates have risen so much. It's very, very dangerous time. So anyway, we didn't have time to get into that, but that's what we're looking at. Why? It's because life insurance and liabilities are very positively convex. They wind much more like that than the assets do, and it's a really tough business. So if you're an actuary, you get into this business, you've got some really tough math to deal with. It's not an easy formula. All right, so I'll see you at the exam. If any of you are graduating, let me know. I wish you the best.